Hi learners, this is a video for clarifying a doubt of a particular learner. He had raised a question to make it clear, or rather I would say he had made an observation to make it clear as to what is the difference between debt and equity. So let me put it here. Let's say you want to start a business. And the cost of business, let's say it's going to cost $100 million. So you want to start a business and the cost of business is $100 million, and what you will do with this $100 million? You will purchase assets. So you will raise money of $100 million and you will use the money for purchasing the assets. Assets can be in any form. It can be in the form of land, it can be in the form of building, it can be in the form of plant and machinery, it can be in the form of furniture and fixtures, it can be in any form. So I'll put it in the balance sheet form. We know that balance sheet is a statement which will list the financial position on a particular date. Financial position is nothing but what are the assets and liabilities you have. And I said you want to start the business at a cost of $100 million. So I'll write here it is $100 million. So this is your total asset. You have total asset of $100 million. And I'll give the breakup for this 100 million just for simplicity. Let's say you have land and building. Let's say it is $50 million. And you have plant and machinery. $50 million. So it's clear now. You have $100 million worth assets, and those assets are basically two assets. One is land and building, the other one is plant and machinery. But now the question is, how you got these assets? How you can purchase these assets, or how you can own these assets? It is not possible for you to own these assets unless you bring money for purchasing these assets. So it means you should have raised $100 million for acquiring these assets. Now the question is, how you have raised this $100 million? Is it your own money, or is it someone's money, or is it, I'll say, outsiders' money? Because in business you can have your own money or you can have outsiders' money also. Is it possible to have outsiders' money in business? Yes, very much, because every business will borrow from bank. Bank money is an outsider money. It's not business owns money, it's outsiders' money. You also raise money through debt instrument, maybe in the form of debentures, in the form of bonds. All these are outsiders' money. So you can raise money from outsiders. It means you are borrowing from outsiders for funding your assets. And you can also bring your own money to the business. It can be either in the form of owner's money, which is called as share capital. And if the business is already making profit, and if you are not taking profit to home but allowing the business to retain that profit, it will be called as reserves and surplus, and that is also your own money. So own money can be collectively called as equity, whereas outsiders' money can be called collectively as debt. So you can finance your assets in combination. It can be in equity, it can be in debt. So now let us assume that this $100 million assets you have purchased by raising money from two sources. One is equity. Equity is nothing but your own money. Let's say you have brought in share capital. Share capital is nothing but the money raised by issue of shares. And let's say it is $50 million, and you have borrowed from bank. So you have borrowed from bank, and if you are borrowing, it will be called as debt. Debt is something which you have to repay. So it is bank loan, it is repayable. So it is another $50 million. So both the money are repayable. Equity is something repayable to the owner, but not during the lifetime of the business, but when the business is closed, whereas debt is something repayable as per terms and conditions of your borrowing. If the terms and conditions says you have to repay within 5 years, you have no other choice, you have to repay. So both the money is repayable. So anything which is repayable will be called as liability. So these two amounts will be shown in liability. So now I believe that I have explained you what is debt and what is equity. Equity is something which belongs to the owners, and debt is something which is borrowed from outsiders. So what is the difference between the debt and equity? What is the difference between the debt and equity? See, for equity, the return which you pay will be dividend, whereas for the debt, the return which you pay will be interest. Number 2, equity is not repayable during life. So I'll write it is not repayable during the life of the company. Of course, there is an exception. It is not repayable during life, whereas debt is repayable as per terms and conditions. Here I said equity is not repayable during life. Of course, there is something called buyback wherein equity can be repaid, but that will happen only with cash rich companies. And third point is equity shareholders have to be paid this dividend only when the company make profits. So if there is loss, then no dividend. Whereas in case of debt, you have to pay interest and principal whether you make profit or you suffer loss. It is immaterial for the lenders that whether you are making profit or suffering loss, you have to pay the interest and principal. And number 4, there is a major risk in case of equity because you are exposed to the business failure, you are exposed to loss, whereas in case of debt there is less risk, because let whatever be the performance of the company, whether you make profit or suffer loss, you will get back to your interest and principal. And the next major point is equity is very costly fund. Equity is very costly fund, whereas debt is really a cheap fund. Why equity is very costly? It is because of the risk involved in the equity, whereas debt is cheap because it carries less risk. And another point, the interest which you pay for debt is considered as expense, whereas the dividend which you pay for equity is not an expense, but it is rather called as sharing of profit. But what is significance in this? There is a significance because if you pay interest, it is considered as expense, it will reduce your profit, and in turn it will reduce your tax. Whereas if you pay dividend, it is not considered as expense. So it will not reduce your profit, it will not reduce your tax, because you are going to pay dividend in the profits after tax. I hope these differences are sufficient to distinguish the equity and debt.
Are you struggling in understanding financial management concepts like time value of money, financial ratio analysis, cash flow analysis, fund flow analysis, cost of capital and capital structuring decisions, capital budgeting, and working capital management? Then this course is for you. Financial Management: A Complete Study. One of the comprehensive course in financial management, at the most affordable price with lifetime access. Explore and enroll now.